5 bills you're paying right now became completely optional the day you turned 6'5". Nobody told you. The bank won't tell you. The insurance company definitely won't tell you. After this video, you'll know exactly which 5 bills they are and exactly how to stop paying them permanently.
Here's the thing about turning 65. A switch flips. A whole category of fees, charges, and premiums become legally optional. Not because you called and complained, not because you proved hardship, but simply because of your age. The problem is the system is built to keep charging. No bank sends a birthday card that says, your monthly fee is now waived. No insurance company calls to say, you probably don't need this anymore. The charges just keep coming until you stop them. Today, I'm covering 5 specific bills you can stop. Real dollars, real phone numbers, real forms. Each one takes less than an afternoon to fix, and the total savings for most people lands somewhere between $4,000 and $10,000 a year. Let's start with the biggest one. If you left a job anytime in the last 20 years and never moved your 401k, you're paying a fee that most people don't even know has a name. It's called a plan administrative fee. It covers record keeping, compliance testing, and the third-party vendor your old employer hired. Now, here's the trick. These fees aren't listed as a line item on most statements. They're baked into the fund expense ratios. You don't see a charge labeled fee. You just see a return that's a little lower than the market actually did. The average old employer plan charges between 0.5% and 2% of your balance every single year, not of your gains, of your total balance. On a $300,000 account, that's between $1,500 and $6,000 a year, every year, gone. And here's the part that should make you move. If you roll that same money into a personal IRA at a low-cost custodian, Fidelity, Schwab, Vanguard, that fee drops to essentially zero. The exact same investments, the exact same market returns. Suddenly, you keep that thousands of dollars instead of giving it to a record-keeping company your old boss picked 15 years ago. How to fix it? Call the plan administrator listed on your most recent quarterly statement. Say these exact words. I want to process a direct rollover to my personal IRA, a trustee-to-trustee transfer. Those words matter. It means the check goes directly from the plan to your new IRA. Never touches your hands. No taxes withheld, no penalty. Takes about 20 minutes on the phone. If you've ever seen a mailer that says, supplement your Medicare, only $29 a month, and signed up, listen closely. You may be paying for coverage you already have. These are called specified disease policies or hospital indemnity plans. They pay a fixed amount if you're diagnosed with cancer or admitted to the hospital. They sound smart, extra protection, low monthly premium. But if you're on original Medicare with a Medigap plan, or if you have a Medicare Advantage plan, your hospital coverage is already comprehensive, day one. The deductible is capped. The out-of-pocket maximum is capped. So what are you actually getting from that separate policy? In most cases, a small fixed payment that stacks on top of what Medicare already pays. You pay $30 a month for 10 years, that's $3,600. You file one claim, they send you a $1,500 check. The math doesn't work in your favor. The National Association of Insurance Commissioners lists these products among the most complained about in senior finance. Multiple state attorneys general have sued carriers over the marketing of these policies. How to fix it? Find the declaration page of any standalone cancer, accident, or hospital indemnity policy you're paying for directly, not through an employer. Look for the cancellation clause. Write a simple letter, I am canceling policy number X effective immediately. Please refund any premiums paid beyond the current month. They are legally required to stop the automatic drafts. If you carry a credit card with an annual fee, even if you've had it since the 1990s, you are not required to keep paying it. Most people assume the annual fee is part of the deal. You get the card, you pay the fee. But here's what the credit card companies don't advertise. Almost every major issuer has an internal process for waiving annual fees, especially for customers who have been with them for a long time, and especially for customers over 65. Chase, Bank of America, and Wells Fargo all have specific fee waiver programs. Some are based on account age, some based on a senior checking relationship, but none of them proactively tell you about it. There's also the product change option. You call them and say, I want to keep my account open, but I want to move to a no annual fee version of this card. They do it. Your credit history stays, your credit score stays, the fee disappears. How to fix it? Call the number on the back of your card. Say this exactly. I'm over 65 and I'd like a senior fee waiver or a product change to a no-fee version of this card. If they push back, say the second sentence. Then please process a product change to the no-fee version. I want to keep the account, but I will not pay an annual fee. They almost never refuse a product change. Every month, millions of seniors pay between $12 and $25 just to have a checking account. It's called a monthly maintenance fee, and at most major banks, it is completely waivable once you're 65. Bank of America waives it at 62. Chase has accounts that waive it at 65. Wells Fargo has a clear access banking account with no monthly fee for seniors. These are published policies. They exist in writing, but no teller mentions it when you walk in. No statement prints a message saying, you now qualify for our senior fee waiver. If you opened your account 30 years ago, you're still on the standard consumer fee schedule. You aged into the waiver. The bank knows it. They're counting on you not knowing it. How to fix it? Walk into a branch with your ID. Say this. I'm over 65 and I'd like to convert my account to whatever tier has the monthly fee waiver for senior customers. If they say no such option exists, ask for the relationship or preferred tier. If they give you any pushback, walk across the street to a credit union. Most charge 0 monthly fees at any age. Life insurance has a purpose. When you bought it, the purpose was probably replace your income if you die, pay off the mortgage, put the kids through college anyway. At 65, let's check those boxes. The mortgage is either paid or close to it, the kids are out of the house and working, and if you have a spouse, Social Security survivor benefits already provide a spousal income floor. Yet millions of seniors keep paying $80, $150, even $300 a month for life insurance they no longer need. Whole life and universal life are the worst. Premiums only increase as you age, and the cash value inside the policy often grows slower than a basic savings account. Don't just cancel it. That can trigger a tax bill if there's cash value. Instead, ask the insurance company for something called an in-force illustration. It shows you exactly what the policy is projected to do from today forward. Then you have 3 options: surrender it and take the cash value, or do a 1035 exchange into a fixed annuity. That moves the cash value tax-free into a product with no ongoing premiums. Or if you still want some coverage, ask to convert it to a paid-up policy, a smaller death benefit with 0 future premiums. How to fix it? Call your insurance company, request an in-force illustration for your policy, then ask for the surrender value. Compare that number against what you've been paying. In most cases, the answer becomes obvious. I leave you with a real one. A client named Charles came in for a routine estate review. He brought a shoebox full of old statements. He was paying $187 a month for a whole life insurance policy that would pay his daughter $25,000 when he died. We ran the numbers. He had been paying $187 for 11 years. That's $24,642 in total premiums for a $25,000 death benefit. He was 4 years away from paying more in premiums than his daughter would ever collect. We surrendered the policy. He got the $4,222 cash value in hand, and he stopped paying $2,244 a year for something he didn't need. That's the thing about retirement. The old safety nets, the ones you bought when you had a mortgage and dependents and a 30-year career ahead of you, they become the new money leaks if you never look at them. 5 bills, 4 phone calls, a couple of forms. Real dollars back in your pocket every month. The only reason these charges are still hitting your account is because nobody ever told you they were optional. Now you know. Subscribe if you want the next one. I break down a new senior money secret every week.